We're talking about what is a bank. And in the equation of a bank, you have two sides, the people who have money and people who need money, and the bank intermediating between the two. So, a person who has money, his issue is where's he going to keep the money? He could keep it at home, but it's not safe. He could carry it with him all the time, but again, it's not safe and it's not practical. He could give it to a trusted person for safekeeping, but then who do we trust? And the more money that you have, more these become an issue. And we still didn't solve it. We still have a problem where do we keep our money? Now, the second part of the equation is the people who need money. So this person needs to borrow money for whatever reason. So who would lend him money? He could go to family, friends, or colleagues, but is it going to be enough? And is it courteous? Is it nice to ask people for money? Um, we could ask other people who have money to lend them money, but the issue is they will charge them interest, and it could be really high interest. It could be very short period of time, so the interest may be too high. The maturity or the period that you need the money may not be as much as you need, as long as you need, and it may not be as easy as you think. So, and also, is it safe to borrow from other people? There's a concept called loan sharks that try to give you as little money at exorbitant levels of interest and as little amount of time as possible. And the point is to get your money, right? So we still have an issue. Where do we keep our money and who do we borrow from? Right? So the bank intermediates. We have the people who have money and they're going to give the money to the bank. And we have the people who need money and they're going to borrow from the bank. So on this side, we have the people with the money. Some of them will actually have the money and they don't need it for a very long time. They're saving for retirement, they're saving for college, they're saving to buy that beautiful car. They just don't need the money right now and they won't need it for a long time. And you have, type B, for instance, that they have the money, they just don't need it immediately. They may need it next year, but they just don't need it now. And then you have I call them C, where you have money, but they just don't need it immediately. They may need it tomorrow. Um, they just don't need it now, but they may need it tomorrow. So the need may be immediate. So they simply don't want to part with their money for that period of that long of a time. On the borrowing side, um, D needs the money for 30 years, perhaps buying a house, perhaps building a new business. E needs the money for at least a year or maybe five to buying a car, buying an RV, maybe home renovation. And F needs the money perhaps just to make the ends meet for this month. Has some expenses and the paycheck is just not enough. So, borrowing to have until that second paycheck comes in and that sort of thing. So you can see where I'm going with this. On one side, you have different kind of clients who have money, but their need for the money um, has different time frames. A don't need it for a very long period of time. B needs it perhaps a little uh, shorter period of time, and then C needs it immediately, or maybe not immediately, but maybe tomorrow, maybe next week, a short period of time. So the short, interim, and a long period of time, and the same applies to the borrowing side. Some people will need the money for a very long time, interim, medium time, if you will, and then the short period of time. So the problem with the bank is people usually need the money for a long period of time. So when we need the money, we need it for 30 years. And if you think about it from your own situation. When you buy a house, that's usually a few $100,000. But when you use a credit card, that's usually a few $1,000s. So when we need the money in large amounts, we usually need for a longer period of time. And we don't like parting with our money. If possible, we like to see our money right there. So people usually need the money for a long periods of time, but we usually would like to have immediate access to our money. So that's a challenge for the banks. And the banks need to maintain a balance between borrowers and the lenders. So money, just like any other property, has usage. You have a house, you live in it, or you rent it. So you have money, you spend it, or you rent it. So people are willing to pay rent for borrowing money, just as you're willing to pay rent if you actually rent a house or rent a car. When we rent money, we call it interest, and people charge rent for lending their money. So very much like if you had a house and you wanted to rent it out, you will charge a rent. So same thing applies to money. If you have money, you want to lend it out, you're going to charge interest. You want to borrow, you need to pay interest. So the banks intermediate and they charge a fee for this intermediation. In fact, what they're going to charge is they're going to charge 5-6% right here, and they're going to pay 2-3% right here, and the difference will be their their fee. So banks pay interest to deposits, very little, but they do, and banks charge interest to money that they lend, a little bit higher than what they're paying right here. So the difference between these two is how banks make money. And banks also charge service fees. Anytime you make a wire transfer, you pay $5 or $10. Those add up. But the banks have costs. They have buildings, staff, software, security, insurance. So they add up too. And they are not charity institutions. They're there to provide a service and charge a fee. So we shouldn't treat them as charity institutions. And they're heavily regulated. So we should know our rights, but we should also know that they're there to make money. And we should just protect our rights when it comes to banks. And we should know that they are a business of, they're in the business of making money with money. Um, and that's about it. So thank you.